Guys, this short lesson will be dedicated to one very important question, namely, how to calculate the volatility for each currency pair in your portfolio. Why do we need volatility? I will answer that in order to essentially set this size in points for averaging. It basically means the distance between each trade. Right now, at this very moment, we have a total of 300 pips set by default, which is equivalent to 30 points. To find out the current volatility of, for example, the New Zealand dollar against the US dollar, we need to go to the website called investing.com. I will leave a link to this site below this video for your convenience. In the menu of this site, we find the section labeled Tools. Click on that tab, and in the drop-down list, we select the option Currency Volatility. We click on the link and go to this section. We can view the volatility of each currency pair practically from our portfolio, and even more than what is in our portfolio. We can see their volatility calculated over different numbers of weeks. By default, it is set to 10, which means 10 weeks, the 10-week average volatility, so we keep this value. For example, we were just looking at the currency pair New Zealand dollar against the US dollar, and here we see that we check the box for the NZD USD currency pair here, and then we click calculate and observe the charts and bars of this volatility. We don't need that information. We only need the volatility in points, which is 61 points on average. So we go back to the trading platform, open the utility settings, and here we write not 61 as shown there because it is shown in points, and our calculations are in pips. Pips are multiplied by 10, so we need to multiply by 10, which will give us 610 pips, equivalent to 61 points. Now, we click OK, and the utility will add additional trades at a distance of 61 points from the first trade position when averaging. Thus, for each currency pair, we can determine the distance for averaging. Similarly, we can calculate the stop loss. We will discuss the stop loss in one of the upcoming lessons. Right now, we are simply looking at how to find this measure of volatility. Let's return to the volatility table. I can show you that, for example, for the currency pair Australian dollar against Canadian dollar, it is 67 points, and for Australian dollar against Swiss franc, it is also 67. For example, the Australian dollar against the New Zealand dollar, 70 points, and so on. That is, for each currency pair, for example, points against the Australian dollar, 134 points. As you can see, currency pairs can have completely different values, different volatility values. And this is extremely important for calculating volatility here, for calculating the distance values for averaging, and also the distance for the stop loss order. This way, you will understand what value to set here in the settings. You can choose for each currency pair. If you use the averaging function that we discussed in the previous lesson, you can find the volatility through the table on the website investing.com using this averaging function. That's all. This short lesson is over. See you in the next lesson.